Every time you open a browser, or even just turn on a screen, you're just bombarded with advertising.
Constantly.
Ads for these giant national banks with like a global reach, and then ads for your local community credit union promising you much better rates.
Right.
The financial landscape is just flooded with choices, but that doesn't really make the selection any easier, does it?
No, but it makes it harder.
So the mission of this deep dive is to give you a shortcut to being well-informed, to help you find the right financial partner for your unique path.
Mm-hmm.
We've synthesized a whole stack of sources comparing these two major players, banks and credit unions, exploring the trade-offs, and maybe most importantly, outlining the essential steps for anyone, especially newcomers, trying to build their financial identity in the U.S.
There's a lot of jargon to cut through.
We need to cut through it all.
Okay.
Let's unpack this.
What's fascinating here, and where we have to start, is with the structure. Because the foundational difference between a bank and a credit union, well, it dictates every single consumer benefit or cost that follows.
Okay, so what is that difference?
Banks are for-profit institutions. They're owned by stockholders, by investors, and their ultimate goal is pretty straightforward: monetary growth and generating maximum revenue.
For those shareholders.
Exactly. And they do that mostly by maximizing the interest they charge you on loans and the fees they collect from customers.
And the credit union, or CU, it just flips that model entirely.
It's completely.
They are legally defined as not-for-profit cooperatives. This means they are owned and managed exclusively by the people who use them, their members.
There are no external shareholders demanding a cut. That changes absolutely everything.
So if they don't have outside investors to pay, where does the profit go?
It gets returned to the members. That's why you see credit unions pretty consistently offering higher interest rates on your deposits. Your savings account actually grows faster, and significantly lower interest rates on loans.
Mortgages, car loans, that kind of thing.
All of it.
That structural difference even shows up in staffing, which was a detail I found really surprising in the source material.
How so?
While big banks mostly use salaried employees across their, vast national footprint, a lot of credit unions still rely, at least in part, on volunteers.
Community leaders.
Right, community leaders. It just reinforces that local member-owned feel.
That local focus, though, brings us to the biggest catch about credit unions: the field of membership requirement.
Yes.
A bank is generally open to anyone over 18 with sufficient ID. A credit union, on the other hand, requires a common bond.
Right. You have to share a specific attribute. That could be your location, you live or work in a certain county.
Or your employer, a religious group, even a specific cultural affiliation. This exclusivity is how they keep that tight, member-focused cooperative identity.
So if we connect this to the bigger picture, this whole nonprofit member-owned structure is the reason CUs can be so competitive on rates.
It is. Our sources showed some CUs advertising savings rates as high as 6%.
6%. That sounds amazing, especially when the average savings rate at a traditional large national bank is a meager 0.05%.
It's practically zero.
That's practically zero growth. But let me ask a critical question here, drawing from the source material. Is that 6% rate universally available? Or is it for, niche products with a lot of restrictions? What's the reality for the average person?
That's an excellent question and a crucial point. Those headline-grabbing rates are almost always conditional.
There's the catch.
There's the catch. They might require a maximum balance cap, or maybe you have to meet specific monthly debit card transaction targets. You have to jump through some hoops.
I see.
The 0.05% at the mega bank is standard, but the high CU rates do require work. However, I should say that even the standard CU rates are generally higher than the standard bank rates.
And when you factor in fees, the cost difference just widens dramatically.
Oh, for sure.
Banks, driven by those shareholder demands, they charge significant fees. Monthly maintenance fees, annual fees, and those notoriously high overdraft fees.
Which can be triggered if you just dip below a required minimum balance, like, say, $500.
Exactly. It feels punitive just for being a basic account holder.
That's the profit mechanism at work. But, to be fair, banks still hold significant advantages because of their massive scale and financial muscle.
Like their networks.
Their networks, more ATMs, both in the U.S. and overseas, and they offer a far broader spectrum of complex financial products.
Like what specifically? When we talk about a broader product spectrum, what can banks offer that smaller CUs usually can't touch?
Well, they really excel at highly specialized services. Think advanced commercial banking tools for businesses, or sophisticated wealth management.
Yep.
They're more likely to offer specialized trustee services, managing assets for future generations, or a full suite of individual retirement accounts, IRAs.
Which are crucial for long-term savings.
Right. For a newcomer, these might not be an immediate priority, but it shows the breadth of access a large bank provides down the line.
Technology is another huge trade-off. Big banks, with their immense budgets, are almost always leading the pack with, cutting-edge digital banking, really strong websites, and polished mobile apps.
Yeah, a lot of credit unions, while they are improving rapidly, they're just operating on smaller tech budgets.
But they seem to compensate in a really vital area, customer service.
They do. Because of their smaller size and member focus, CUs generally offer better, more personable service. They treat you like a member, not just an account number.
And they have that shared branch network to make up for the ATM gap, right?
They do, the co-op shared branch network, which lets CU members use thousands of other credit union branches nationwide as if they were their own.
So if having every modern financial product and, say, global ATM access is paramount for you, a bank might be better. But if community focus, better customer service, and maximizing every penny through low fees and better rates are key.
The credit union is a very compelling choice.
Now let's talk about the practical reality for newcomers. We have to address the data showing massive financial exclusion. This, to me, is where the structural comparison becomes less about rates and more about fundamental access.
Absolutely. The data is stark. Approximately 7.7% of U.S. households, that's over 9.6 million people, are completely unbanked.
Meaning no checking or savings account at all.
At all. And another 20% are underbanked, so they're relying on expensive alternatives like check cashing services.
But here's the crucial number from the sources.
Yes. 51% of foreign-born non-citizens fall into one of those two categories. Half. That means half of all newcomers lack full financial access, and that is a major barrier to building a stable life here.
Why is that number so high? Our sources identified a few key barriers. One of the top reasons cited for being unbanked is a lack of trust or just a dislike of banks.
Which was reported by 15% of respondents in one major survey.
Then there's the massive hurdle of language. Spanish-only households are 5 times less likely to use a bank or credit union.
Language access is getting better, thankfully. Many institutions are responding. The CFPB, for instance, offers call center support in over 180 languages.
That's right.
But the most immediate practical barrier for a newcomer is often just identification.
Finding an institution that accepts non-traditional documentation is, like you said, the first major victory.
Right.
And increasingly, banks and CUs are accepting passports, consular IDs, and foreign driver's licenses, often paired with, a utility bill as proof of address.
This is where the small, community-focused credit unions often really shine. They're more nimble, more willing to work with local populations.
And some offer specialized products, right?
They do. Some CUs have what are called safe accounts, designed specifically for individuals without an SSN or an ITIN. They provide basic checking and savings and are often structured to avoid generating IRS reportable interest.
That being said, for full financial participation, especially if you plan to work or file taxes, you will need an official identification number. Let's just quickly clarify the two main types.
If you're authorized to work in the U.S., you need an SSN, a Social Security number. If you're not eligible for an SSN but you have to file a U.S. tax return, you need an ITN.
An individual taxpayer identification number.
Exactly. They're 9-digit numbers issued by the IRS just for tax processing. They always start with a 9. And crucially, an ITN does not give you the right to work in the U.S.
That distinction is paramount.
It is.
Okay, so establishing that first account is step 1. Step 2 is arguably the most intimidating part of the system for anyone coming from overseas, building U.S. credit history. And here's where it gets really interesting.
Because your credit history from your home country, no matter how good it is,
It doesn't carry over.
it generally does not carry over. You are starting from zero. You need documentation showing anywhere from 1 to 6 months of on-time payment history just to generate your first U.S. credit score.
Which ranges from 300 to 850. And the FICO score model, which is used by almost all major lenders, is broken down into 5 factors that you really have to understand if you want to succeed. Let's walk through the percentages, because this tells you exactly where to focus your effort.
Okay, the biggest piece of the pie is payment history. That's 35%.
Simply put, pay every bill on time, every time, no excuses.
No excuses. The second largest factor is credit usage at 30%. This is the ratio of how much debt you carry versus your total available credit limit.
And the goal is to keep that ratio really low.
Very low, ideally below 30%, and many experts recommend under 10%.
Okay, then you have length of credit history, which is 15%. This tracks the age of your oldest account and the average age of all your accounts. Time is literally money here.
It is. And the final two are smaller but still important. Credit mix at 10% and new credit activity also at 10%.
Let's pause on credit mix for a moment because this is often confusing for newcomers. When we talk about managing different types of debt, we're talking about two main categories: revolving credit and installment loans.
Can you clarify that?
Sure, revolving credit is what you see with credit cards. You're given a credit limit, you use the money, and as you pay down the balance, that credit becomes available again. An installment loan is for a fixed amount, like a mortgage or a car loan.
Ah, so you borrow a lump sum and you pay it back in fixed monthly installments over a set period.
Exactly. And showing you can handle both types well is what lenders want to see.
Okay, so understanding those rules is the first step, but how do you actually start from absolute zero? What are the most accessible credit building products available?
The primary tool for anyone with limited history is the secured credit card. It's designed specifically for this audience.
How does that work?
It requires you to place a refundable security deposit, maybe $200, up to $5,000, and that deposit immediately becomes your credit limit.
So it's secured by your own money.
Right. You use the card like any normal credit card, making purchases, paying the bill on time, and all that activity is reported to the credit bureaus. It's a low-risk way for the issuer to track your behavior.
And you get the deposit back.
If you close the account in good standing, that security deposit is returned to you. It's a fantastic starting point.
Another option that ties back to that credit union model is the credit builder loan. These are usually small, anywhere from $300 to $1,000.
And they work kind of counterintuitively.
They do. The credit union lends you the money, but they immediately place those funds into a locked savings account. You don't get the cash up front.
Instead, you make regular on-time payments, which are reported to the credit bureaus. It's like a forced savings plan and a credit building tool at the same time.
And once the loan is paid off, you finally get the cash. It's credit history with zero risk to the lender.
Beyond formal loans, you can also leverage other people's good behavior. If you are added as an authorized user on a family member or friend's established credit card.
As long as they're responsible.
Yes, as long as the primary cardholder maintains a positive payment history, that history gets reported on your credit file. It's a shortcut, but it requires enormous trust.
It does. And for those building credit through community ties, especially immigrant groups, we should highlight lending circles.
A great option. These are cooperative group systems where members pool money together and then take turns receiving the total pooled funds.
What's great is that some nonprofits, like the Mission Asset Fund, have formalized this traditional community practice by reporting the repayment activities to the credit bureaus.
So it transforms a cultural system of mutual support into a formal credit-building tool.
Which is a really powerful way to leverage existing trust networks.
Finally, for those who already have an SSN and a bank account, there's Experian Boost.
A free service?
Right, a free service that connects to your bank account and adds eligible on-time payments for things like utilities, rent, and cell phone bills to your Experian credit report.
It gives you credit for bills you're already paying.
Exactly. It can be an immediate boost to your FICO score.
We've covered everything from the deep structural differences to the exact tools needed to jumpstart a financial life here.
So the choice is personal. It's balancing the convenience and advanced tech from banks against the lower costs and personalized service you get from credit unions. Success really relies on finding the institution that fits your immediate needs for access and then your long-term needs for growth.
And that leads us back to a hidden cost, which is particularly relevant to many newcomer customers, the total cost of international transfers or remittances.
Ah, yes.
We mentioned earlier that banks and credit unions handle fees differently, but that advertised fee, say $20 to $50 flat, is rarely the true total cost.
It's not the whole story.
This raises an important question because immigrant customers so frequently send money home. Both banks and credit unions typically add a non-transparent markup or spread to the exchange rate they offer you.
So you might see a low wire transfer fee, but the exchange rate you receive is secretly inflated to generate extra profit for the institution.
Exactly. That hidden markup on the currency exchange is often the true, non-obvious cost that eats into the remittance amount. You might think you're getting a good deal on the wire fee.
But the hidden spread on the exchange rate can cost you significantly more than an advertised fee ever would.
So as you build your financial life here, remember that the initial choice of institution is critical, but the total cost of moving money internationally might be determined less by that advertised wire fee and much more by that invisible exchange rate markup.
Something to consider as you build your financial life. What would the true cost analysis look like if every institution was required to show you that markup, that profit spread, up front before you committed to the transfer?